today, new construction is down, rent growth is down, and this is creating a massive opportunity in the market today. And so today we're going to be breaking down, my partners and I, exactly why we are actually more aggressive in today's market than we were even a few years ago, investing in multifamily apartments, and where should you be looking. So if you're new to the channel, we are here to share our experience in building a $500 million portfolio of apartments. And we're going to help every single person grow their own portfolio, leveraging capital partners to help fund the deal so you can grow much faster. So with that, let's dive in. Make sure to subscribe if you want to continue getting content like this. But we got Randy on here, Larry on here. These are our partners, and got a lot of experience in this game. But in the current market, there's not much new construction happening due to heavy construction last year. And people are probably looking around seeing all the buildings going up. Those projects started years ago, you know. And not only that, rents are down, at least some. They're weighing down. Maybe they're stabilizing in a lot of areas, but demand's also down with that, right? So let's dive in. Randy, what's
Yeah,
your take?
so yeah, for sure. I mean, again, a lot of times people see the negative news and it feels negative, but like, so you had, deliveries of new construction and apartments last year was based off of activities that took place in 21, right? And the deals that were locked in there, the interest rates were, 4.5, 5, 6%. And then rates skyrocketed in 22, which pretty much, killed off all the new construction for the most part. So you've got, the last several years, the developers have not started a ton of new projects because the mechanics of the numbers didn't work because interest rates were so high. And so, you had a lot of delivery that come into certain markets, not every market everywhere. And then that caused, a bit of rent suppression. The surprising thing is that there was a greater absorption rate than people anticipated, meaning as new apartments came onto the market, people took them. And, part of that is also because less people were buying houses, right? I mean, because interest rates are up and it doesn't make sense for them to buy a house. So all of that coming in, you're already starting to see in many markets that, A-class new construction pricing is starting to stabilize. But then, the value of what, Jonathan's also saying is that in the next 2 years, they're projecting CoStar and others that you're going to see beginning, dynamic rent growth. And the reason for that is there's been no new construction, no new supply. In many of these markets, you still have people that are moving into the markets for job reasons, geopolitical reasons, those kind of things. And because of this elevated interest rate the last 3 years, it's really put a damper on new construction starts for multifamily. So that's a great thing, with which when you look at that, what does that mean? It means that then there's opportunity that's there, both from the demand proposition that you would expect to see in the market, call it 26 and 27, meaning more people demanding apartments, which fuels rent growth, less properties coming online. And so then that creates opportunity. The other thing, when you look at and talk about distress, is that there are projects that were, maybe called finished in 22, and they are struggling because, part of what that is that they were anticipating potential sale or stabilization with lower interest rates.
Yep.
Lower interest rates haven't materialized. I mean, I was just talking with a partner on a deal that they were looking at, that's a 2022 year new build, right? Exactly what I just said. It was finished in 22 and it's struggling. And the reason it's struggling is because interest rates are high. And so the economics of it don't pencil out exactly to how they underwrote it back when they built the deal, starting call it in 2019.
Yep.
So, a lot of good mechanics that present opportunity. I think,
Yep.
as you were saying, Jonathan, down, 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 it's like I felt like jumping and saying up, you know what I mean? Because
Yeah.
like when everything's kind of projecting negatively, you watch it and it makes you feel negative.
Yeah.
But it's really an inverse correlation, like Warren Buffett said, the quote that Jonathan, when there's blood in the streets, that's the time to buy.
Yeah.
Most people, don't have the courage or the stones to want to do that. Well, let's wait to see what takes place. And that's where data and understanding those things really can be your friend.
Yeah, exactly. And the market's cyclical. The cycles are going to come back around. It's really not, even the interest rates, they're really not that high compared to, a long time ago, right? I mean,
Well,
they're really not that bad. I mean, it's just the people who don't like the market are the cynical ones that are just pessimistic anyway,
yeah,
right?
well, I mean, so again, it's like, Jonathan's true. It's like interest rates relative to history are not high, but it's high for like example, that
Yeah,
22,
exactly.
when you're anticipating stabilizing with a 4.5 rate and you're ending up in the market at a 6.5 rate, you bet your ass you're in trouble because that's a 50% increase
Yeah.
in cost of capital, your money. You went from four and a
Yeah.
half to 6.5. That's 2 points more. It's like 42% higher than you anticipated. So that is a challenge. But
Yeah.
for us sitting here going, okay, well, hey, let's look at buying that deal. It's not a challenge. It's a mechanic of the price that, like, okay, well, the price needs to be the equivalency of what the debt is. And so, unfortunately, their equity gets wiped out or haircut dramatically, and now it becomes a good deal.
Yeah. Rates feel real high if you bought at a 4.5 cap rate, your loan's due, right? But if you're starting now and aggressively buying, you can underwrite for the appropriate interest rate. And I think Warren Buffett also said, do what everybody else is not doing, right? So there's no
Yeah.
doubt, feels like to a lot of people, bad time to buy, but and no doubt transactional volume is down, but a lot of people are sitting on the sidelines waiting for something to happen. But there's still sellers out there that need to sell now, right? So
Huge.
you just may have to, and they're harder to, maybe a little harder to make the numbers work. That just means you got to work a little harder, right? You got to
Yeah.
make more offers. You got to
Yeah.
look
Yeah.
at more deals.
I think one of the chat things that was sent in is like, "Hey, where's the honey hole at?" Right? There is no honey hole, man. Like the thing that you're gonna, hey, man, let me find this secret spot where all the gold is that I can just be like the guy on the Lucky Charms commercial and fall into a pot of gold. It's like that's not real world. That's
Was that
not
a
real world.
snapper? Well, they were looking for red snapper, right?
Yeah,
Not
yeah.
not apartments.
Yeah. They were looking for Easy Street. Easy Street doesn't even exist on the game of Monopoly, right? You know what I mean? So it's like
Yeah.
I think the truth of the matter is what Larry said is true. It's like, look, you have to be, yeah, you might have to work harder, and that should be expected right now because of some of the economic constraints that are going on. But when you do find that deal, it's going to be a good deal that presents a great opportunity, and then now you're able to execute on it. And then the underwriting of it works at a, 6.25 rate. And,
Yeah.
and if you've underwritten it properly, and then rent growth goes up, as we've talked about, and then interest rates moderate, which is highly likely, you're now getting extra juice in your deal. Now, so
Yeah.
you don't need to underwrite that in the deal. You make the deal work based on just full stone execution, but now you've got the wind at your back that's, going to even give you a better
Yeah.
return.
Yeah, exactly. And I mean, the way properties are valued, guys, is, your NOI, your how much you are profiting on the deal, right? And so rent concession, the supply is high right now, demand is low. That means it's more competitive when it comes to, getting tenants in there and so rent concessions play a part in this whole thing, right? People are given 3-4 months free up front, right? So then all of a sudden the NOI and the debt, being able to pay the debt makes it hard. And now you're in a distressed situation, right? And so there's opportunities out there for in a high interest rate. The time to buy is when interest rates are high, when vacancies are high, when rent growth is low, right? Like Randy said, when there's blood in the streets, right? So you're buying other people's problems. You're buying opportunities because of issues that are happening on and again, we're not endorsing going out and buying a 20% occupied property. We're not necessarily saying, especially for a newer investor, if you're looking to scale using other people's money, we're not saying to do that. But if you can find an opportunity where there is some room to grow, some room for value add, maybe the changing out the management a little bit, maybe there's some light to moderate value add opportunities, that is a good deal, right? And so it's just a matter of do you understand how to create lead flow, right? Getting off market deals, finding deals. And so we have videos that talk about that. So if you want to know how to generate more deals, go check those videos out. But people ask where are the honey holes and all that kind of stuff, man. At the end of the day, you got to underwrite each property and look in all areas. Some of the best deals are found in the most unexpected areas. If you're looking for the highest growth areas, you're also in the most competitive areas. You got to understand, like, some of these deals are found in a town of 30,000 people, right? Or 40,
everywhere USA.
right?
Mhm. For
you know,
sure.
so main I was just in one day out, not too long ago, I was looking at a property in Atlanta, Georgia. It was 20, 30, 40 units, something like that. It was like $8 or $9 million. Same day, I'm looking at a deal, 96 units in Birmingham, Alabama, for $7 million. And it's not to say that the $8 million property is better, is worse than the $7 million property. You just got to look at the situation. You got to look at where's the opportunity, what's the underwriting say, what is the opportunity to ahead.
The honey hole is found in hard work, my friends.
Yeah,
Um, that
yeah,
because again, Jonathan just hit the nail on the head. Which deal is better, the 20 unit for 8 million or the 96 for 7? You've got to look at the deal each specifically and understand the deal to be able to understand and discern which is a better opportunity or
yep,
neither. And so if you just put on this hat of like, hey man, I want to go find the honey hole over in XYZ area, you're going to miss the boat because the boat is found yeah, maybe there's not exactly like Larry said, everywhere USA. Maybe you've got a geographic target area that encompasses, like Jonathan said, maybe it's 2 states, 3 states, whatever. And now you're looking at each of the deals that meet predefined criterion that helps you establish what you're able to execute on and make money. You know what I mean? Like that's the
Yeah.
ticket. And
Yeah,
part of
no
being,
doubt.
I'm just saying,
Excuse me,
part of
Randy,
being
go
in a
ahead.
group like this gives you resources and traction and peers that are already doing it so that you can more quickly accelerate.
Yeah. And if we're coaching somebody, I think that's step 1 or 2 is defining your buy box. So you definitely want to do that and decide what fits for you. All I'm saying is there's cash flowing multifamily properties in every town in the country, right? Over
Oh, for sure.
whatever population. That doesn't mean you definitely need to define your buy box and have a good strategy, but there's the trick is finding the right deal, like y'all are saying, based on the underwriting, based on the data, not based on your emotions and
Yeah.
excitement, right?
I was talking to a
exactly.
guy, he's actively buying in San Diego. I'm like, okay. But he lives out there, and just what Larry just said is 100% true. He's actively working and creating opportunities in an area that he knows, and he's not buying everything, but he's buying deals that cash flow and work. And I think he said that even with the rent caps that he had, it was like a 9% rent growth this year was the cap that you could put on it. So he's like, that's more than even market. So
It's
um,
good. Well,
yeah.
yeah, I appreciate you guys joining. Look, if you want to join a group of people that are actively taking deals down in today's market and navigating the times, if you want to join a group of like-minded investors that are scaling their portfolios through apartments, whether you have, some real estate experience, fix and flipping, got a few single family rentals, whatever you have going on, or you looking to scale your portfolio to the next level using capital partners and using syndication like structures, there should be a link in the description below. We'd love to chat with you and see if working together would be a good fit. But I hope this was providing value to you guys. We are over here at a mastermind in Tampa, Florida right now. And so we had to step out. We're not in our usual studio here, but good to see everybody. Hope you have a wonderful day. Make sure to click subscribe. Thanks for joining.
Thanks.
Take
See you later.
care.